to the first in a series of CPD webinars. Thank you for joining us for today's session on making tax digital for income tax and self-assessment. We've had over 100 delegates register for the event, which just goes to show what a hot topic it is. I'm your host, Andy Rainford. I'm a chartered tax advisor, tax writer and editor here at Tax Essentials for Advisors. I'm going to be joined today by my colleague, Tony Court, who has decades of experience from the perspective of both giving tax advice and also conducting tax investigations for HMRC. I'll be leaning on Tony for technical and legal insight today. I'm also delighted to be joined by Natasha Everard, author of the Bookkeeper Superhero, as our expert panelist for this first session. Natasha has worked in the industry since 1997 and is currently the owner of her own practice, Bewitching Bookkeeping Service. She is an advocate for helping others, as evidenced by her founding an online Facebook group which encourages members to share problems and find solutions together. Natasha will be sharing her expert advice into the practical aspects of MTD from her own first-hand experience. Just a housekeeping note, the Q&A session is open and you can access that by clicking on the button at the top, and we will try our best to answer any queries that you've got. But please do bear in mind that we are subject to time constraints and we may not be able to get through all of them if there is a lot. So to kick things off then, Tony, if I can turn to you first. Sure. Making tax digital, we first heard about this about 10 years ago, 2015, and it was originally bannered as the end of the tax return, if I remember rightly.
That's right.
We've had a few changes and delays along the way, and as I say, 10 years down the line, we're still not there. But I believe we have now got a relatively firm timetable for rollout. Can you just remind us what that is and who's going to be affected and when?
Okay, well, certainly we have a fixed timetable for unincorporated, sole traders and landlords. We're yet to see a full rollout, of course, or timetable for companies and indeed partnerships. So what we're talking about here is the timetable for sole traders and landlords, whether they be landlords of residential accommodation or commercial accommodation. So I think everyone knows these dates, but I'm going to run through them quickly just to remind all those that where the dates have slipped their mind. But so MTD for ITSA, MTD for income tax self-assessment, the first mandation, the point at which it becomes obligatory to use MTD for sole traders and landlords is 6th of April 2026, and that will apply to people with qualifying income of 50,000 and more. We'll come back to what is qualifying income later. I think that's an important point. So, Andy, you can remind me to explain that later.
Yeah.
And then the next date is 6th of April 2027, when everyone with in qualifying income of 30,000 or more will be required to join MTD ITSA. And then finally, from April 2028, those with 20,000 turnover or more will be required to join. Those are the mandated dates. You can join voluntarily at any time, and that includes now. It's open. So those are the timetables, or that is the timetable, and we can get into more details about that, how that will operate in terms of, say, new businesses or businesses that cease. If anyone has any questions, have you got anything to add to that, Natasha?
I think it's the fact that we are trying to stop the fear factor with these. This is new to us all. It's not just our clients it's going to be new to, it's actually us who's going to have this whole new processing. And I think the more clarity we can get, like Tony says, to get the facts and figures correct in our own mind and our own practice, then we can provide a better, higher service to our clients and take the pressure and the misunderstanding away from them.
Yeah, sure.
Fair point. And Natasha, just to clarify, MTD ITSA completely different and separate, distinct from MTD for VAT, which we've had in place for a couple of years now.
Yeah, I think MTD VAT was very similar to the previous MTD. It was just about ruling manual input, basically. So you couldn't actually manually type any information in. It wanted that kind of digital link. And I think they've taken that to the next level with the income tax. It's basically highlighting the fact to the clients that it's going to be safer for them to use digital services to save their files, basically take pictures of their receipts, get that information. It's making the clients a bit more proactive with their bookkeeping, not leaving everything to the last minute, not just for the HMRC's benefit. It's going to be a big benefit for our clients. And the way that I see that is a big opportunity for accountants and bookkeepers. Never before have we had this ability that we can actually provide more services and take on more clients, believe it or not, as well.
Yeah, and just to check, I mean, if you've obviously you're going to have clients that are affected by both MTD ITSA and MTD for VAT. Is there a risk perhaps with for bookkeepers or tax advisors, accountants, that they've got clients that are already doing MTD for VAT, which is quarterly, as VAT is a quarterly reporting framework? Is there a risk of complacency, maybe, that we say, well, we're already doing this, there's nothing we need to do to prepare? And if so, how are you sort of managing that and sort of communicating to your clients that actually you need to be doing something different?
Yeah, I think it's all about getting the right information. Like, these kind of webinars are brilliant for our clients as well, not just for the tax advisors, the bookkeepers, and the accountants actually doing it. We need to reiterate to our clients the importance of the fact that that digital information is going to be so much powerful for them, not just HMRC, like I've said before. The importance is the fact that HMRC now requires us to get that information to them earlier. And the more information we have, the more information we can actually help the clients grow their businesses. We can actually provide more services, more advisory, more cash flows. So it's kind of twisting that information that the HMRC wants us to do this requirement, but let's give it an added bonus that we can actually provide more services to our clients. And that's the way it's a win-win for the clients opting for this kind of new way that we have to do. It's not a question of we can't do it or we can get round it. We have to do it.
Can I just jump in there for a second? I actually wanted to go back to a point you made, Natasha, when we were talking about records, and I think just for clarity, it's important that, well, it's a must that there are digital records kept. That does not mean that you have to have digital copies of receipts and invoices. Of course, very often, particularly with software, now you can you can take an image and it'll be automatically posted to your system, but actually you don't need to. So there will be cases where you may have out-of-pocket expenditure for which you've got no receipt or invoice. There will be situations with businesses still issuing paper documents. The point at which the digital journey, as the revenue used to call it, the digital record starts, is the point at which they are posted onto the system. So that may well be if you have a system where you scan an invoice and it does and it makes the necessary postings. It may be then, but actually, if you're manually posting an invoice or a receipt, or then it will be the point at which you post that, the point at which you type that information in. So yeah, that's it was just a point. I think I think I've heard a couple of questions on that, and so once you're in that once that digital journey starts, you have to stay digital from that point onwards.
Yeah, and that's a key point. We'll come on to the details of that later on, I think. But just to elaborate, Tony, whilst we've got you up there, what are the fundamental requirements at the absolute most basic of MTD ITSA?
Yeah, well,
that's quite a wide question, isn't it?
Yeah, it is. Well, yeah, digital record keeping, yes. So from end to end, you've got to have digital records. So that means that a transaction that is recorded digitally must follow its path through to the final, what is the final report or the summary at the end of the tax year, and it must be transferred all along the line. However you do that, so if you're keeping spreadsheets, then that data must be digitally transferred to your quarterly reports, and the quarterly reports must transfer that data to the final, the end of year declaration, which is going to be akin to a tax return. But again, we perhaps need to get into that a bit later. So the fundamentals are digital record keeping, 4 quarterly reports, a year-end report, which will be akin to a tax return, in which you sum up all your digital all the quarterly reports, make any adjustments, add the other information on which is not within MTD, namely your employment income, your savings income, anything else that's outside. So it effectively, that end of year report becomes your tax return, and summarizes your whole position, including the MTD quarterly reports for the year.
And I guess that then feeds into the sort of the final assessment, if you like, and your tax bill for the following January.
Yeah, I said the final report is more or less and in fact, in many circumstances, will look just like the tax return, because you will have to use software for that.
Yeah.
And that software may be the same software that you use for the quarterly reports, but doesn't have to be the same software. It can be, so you might have, for example, a bookkeeping software that you're using from day to day, make your quarterly reports. At the end of the year, you then may have tax return software which you've been using for years, and your software provider will say, okay, this is HMRC MTD approved, and providing it is MTD approved, HMRC approved, it will import that data. That's one of the things. There must be a protocol to import the data digitally from the quarterly reports into the final year-end report. That will be imported. You then make your adjustments to the accounting figures and so on, and then add your other income. That's your final, that's your result, and that then gets submitted, and it becomes effectively your tax return for the year.
Yeah, brilliant. Okay, thanks, Tony. Natasha, in terms of sort of signing or onboarding, if you like, for want of a better word, is this something that's going to be led by HMRC, or does it need to come from the client or indeed the advisor? Because as I believe it, it's the mandating thresholds, the income limits, if you like, are going to be based on the previous year. So, for example, for next year's mandating date, we've got April 26 and the income threshold is 50,000. But that'll be based on the 25-26 figures, I think. Is that correct?
That's 24.5.
24.5.
Yeah. So it's current year -2. Sorry to jump in there, Natasha.
Right.
Yeah, but yeah.
Yeah, and I think it's the choice. I believe that obviously you'll get the mandatory ones, but those are already who are kind of ahead of the game and already using digital services. So like one way is like if you were collecting receipts from them regularly via digital services, that makes the process a little simpler. It's not like, say, mandated, like Tony said, but makes this, and there's nothing to say that, right, you're ready to do this. Let's start the process and get you on this scheme early, so that when you're mandated to do it anyway, you're already doing it. There's a lot of pros and cons, though. You will get the ones who will rebel against it completely. You'll get still the shoebox clients, and this is what this is trying to stop. It's trying to alienate shoebox clients. They're trying to help them get their information rather than lastminute.com, the January blues, that kind of thing. They're trying to make people kind of think that it's a benefit for them. I know I keep saying this is the kind of story we need to tell our clients. It's going to benefit them in the long run, because obviously with real-time information, better decisions and various things like that.
Yeah.
But I do think it's a lot is collaboration with the client. It's making them aware of what they are responsible for, how we can get that information kind of painlessly to get that information into the software. And the great thing for me over the last few months is HMRC took a step back and actually gave So a bookkeeper and accountant can both do the returns. So the bookkeeper is able to do the quarter returns, and if they don't do the year end one, the accountant can do that. And that to me is the biggest thing that HMRT have actually taken on board. That really does help our industry as well.
Yeah, because you're talking about multiple authorizations there,
That's
aren't we? So
right.
do you want to just
Yeah.
talk about that a little bit more? Because I know that's a fairly recent development, isn't it? That's come out in maybe a month or so back. So how will that
Yes.
work in terms of, I'm guessing there'll be a sort of a restricted level and then maybe a full access, because obviously if you're registered for self-assessment,
Yeah.
you've got access to every bit of information. If you then use a bookkeeper for your clients, perhaps you outsource that, they need to be able to speak to HMRC as well, and presumably need to be authorized on some level. Are they going to have access to tax return information as well, or is that going to be?
I think it's very much still an open discussion, the fine tuning of that at the moment. From my clarification at the moment, they are really, I think a lot of people thought to have that kind of two-tier element where the quarterly returns are done in a manageable way, because you're only putting near enough provisional figures, but as real to the fact provisional figures. So the big point here is don't put figures in that is not right, because that's just going to open a can of worms for the HMRC. You need to look at as though you were kind of treat it as though you were doing a VAT return, make sure that sales income is correct and things like that. And this then allows a third party or accountant or anything to do the final return if you're not actually doing this. I mean, a lot of people will do the whole process. They will do the 4 plus the 5th final return themselves, but it does open it up so that, because it'll be an increased amount of clients needing accounting and bookkeeping services, it does allow us to help those a lot more and help those become MTD compliant.
Okay, can I just jump in there, Andy? I was actually talking to someone from HMRC about a week ago on this, and actually what they said quite categorically was that the main agent, which you might say in Natasha's example, if you've got an accountant doing the end of year return and you've got a bookkeeper doing, say, the quarterly returns, the subsidiary agent, the supporting agent, I think as they call them, will not be able to see everything. They will be able to see what they do on the quarterly reports, but nothing more than that. So they won't have details of the individual's other income, unless, of course, the individual provides them to the bookkeeper. So and there are issues here around onboarding, and I think this is, I'm not sure this was on your list of questions, but I think it's really important that bookkeepers and accountants understand that there are 2 options at the moment in terms of getting clients onto MTD. That option 1 is just to register them early. Now, that doesn't actually mean that they will start using MTD. It just means that if you go to your agent services and you link your client to MTD, you can actually register them with effect from April next year, but assuming they're going to be mandated. Or, so that's one option, you can just simply register them. Why would you do that? Well, because otherwise you're going to, as we creep nearer and nearer to the sort of the beginning of next tax year, what you don't want to be doing is storing up a stack of work in order to do that. So you'll just be registering on the system without involving them in MTD at this point. However, you can use the testing MTD, the beta version that's now available, and you can join them now. Actually, even part way through the year, you can join them into the MTD system. So you've got 2 choices there, and it's probably a good idea to try and encourage clients, I would say, and I'll defer to Natasha's greater experience, to try and get a good many of your clients involved now. Why? Because according to HMRC, it takes somewhere between 4 and 6 minutes to get each client set up and ready to use MTD. Now, I don't know, Natasha would probably be able to tell me how true that is or isn't, but the point the point being that if you have got 500 clients, that's, if you're
It's a lot
even
of
saying
time, isn't it?
four minutes of time, yeah, that's 2,000 minutes. So I don't know, Natasha. I mean, you have a number of clients, I think. So it may have taken longer at first until you get used to it. But how long was it taking you to get these people set up, and in terms of the revenue registration?
Yeah, so I've actually got 3 on the trial one. So I was an early adopter for it, and 3 of them were a nightmare to get on. HMR system is never designed for users, basically. No matter how much they try, I would say that's a good estimate of that amount of time. There isn't actually, I couldn't see a facility to bulk upload into that facility yet,
no.
which is what is desperately needed.
Absolutely, yeah.
But yeah, it does take time. It takes patience. It takes of going back steps, because sometimes it doesn't like the answers to it. And we know with HMRC systems, some days it likes us, some days it decides to go on holiday. So I'm a great believer. Tony's completely right. Get started now. Get those on there ready, because it does take time, and it takes a lot of patience as well, I'm afraid.
Brilliant. Well, thanks both. Tony, if I can stick with you for a second, I had a question in the Q&A come up, which actually coincides with something I've got on my little list of curiosities as well. Can we just clarify? So once we're into to MTD, it's as the client, or indeed their advisor, we've got to do these quarterly reports. So what are these quarters? When do they sort of start and finish? And what are the reporting dates? Because I'm guessing it's going to be a bit like VAT, where the quarter ends and then you've got a little bit of time at least to get the information over to HMRC. So we've got deadlines and things to cover.
Yeah. Well, the default periods for quarters are the tax quarters, i.e. 6th of April to April, May, June. So 3 months later to the 5th of the month, and then the next 3 months, which is well, I'm sort of getting the date, but I think you get the gist of it. So it's the tax quarters starting on the 6th of April, ending 3 months later. Those are the default quarters. And then the VAT, and then the quarterly report is the deadline for that is the 7th of the next month. So if your quarter ends on the
the 5th of July, that'd be the first one, wouldn't it?
Well, it's 7th of August. Interestingly, the legislation for that at the moment, just in case anyone panics and looks online and sees a different date, the legislation still says 5th of the next month. But I can absolutely rest assured that it is the 7th of the month, and there'll be a statutory instrument later in the year to amend the regulations, that will make it the 7th of the month. That is the first option. The second option is you can, because a lot of people make VAT returns for quarters and they're calendar month. You can make an election or an option to make the quarterly returns to the calendar month. So from the beginning of April through to April, May, June, so on and so forth. The filing date stays the same. So if you've chosen till the 30th of June, so April, May, June, the filing date is still the 7th of August. So and the same throughout the year.
You're not disadvantaged by, it doesn't change the, as you say, the reporting date or the deadline for penalty purposes. I'm just rereading the question that's in the Q&A. I guess it's asking, each quarter is going to be reportable independently of the other, isn't it? So if you do the quarter one, that's the first 3 months of the year. When you do the second one, you're still only reporting for 3 months. You're not reporting for 6 months, are you? It's not cumulative.
No, it is cumulative.
Oh, it is.
Originally, it wasn't. And what the revenue were going to have an amendment system. So you would let's say you filed the first one, you get to the second one and you are filing it, you realize there was an error in the first one. You would file the second one and also make a correction to it using a system they were going to set up. That's not happened. Now what happens is it's cumulative, and so that any errors you made in the first quarter should be corrected in the second quarter, and likewise, so that in theory, by the time you get to the end of the year, there ought not to be any errors that need correcting. There may still be things like journal adjustments and year-end adjustments that you will always have when you're bookkeeping, and they will be put through with the final return at the end of the year, the final report, or sort of the year-end report, which is separate from the quarterly reports. So no, it is cumulative.
Okay. Yeah, no, that's really helpful. Yeah, so in that sense, then, I mean, we've obviously just gone through basis period reform, which I guess was almost. I mean, you look at it, it's fairly clear that it's a kind of a prelude to tax year basis reporting. When you look at the quarters, are obviously on a end coincide with the end of the tax year. So, if any clients are still, for using, say, a calendar year end, will it make sense to reconsider that at this point and perhaps look at, changing the accounting year end for ease of reporting?
Yeah, I was going to say it's a difficult one. I think it's a matter of personal choice, and there may be good reasons why you have a year end that is 31st December or 30th of June. I know that a lot of people are moving to 31st of March or between 31st of March and 5th of April year ends for their accounts. I would say it's entirely up to you. It doesn't really make the reporting, and I'll defer to Natasha on this in a moment, doesn't really make the reporting, I think, any more difficult. What it may do, is it may make the end of year, if there are end of year adjustments, it may make the end of year reporting slightly more difficult. But since we haven't got to the end of the first MTD year yet, which for the testing period will be at the end of March, I'm not really too sure how much more difficult a coterminous year end will be for accounts. So I would say don't change it now if there's a good reason that you've chosen a year end that doesn't coincide with the tax year end. So Natasha, have you got you've got more? You might have more insight on that. So is there any?
I think I totally agree with Tony. I wouldn't change it for now, but I have seen people where they've actually changed their VAT quarters to mimic the new MTD income tax, because it'll make it so much easier that way. So they're not necessarily changing the year ends, they're changing the VAT quarters to mimic it, so that one report is done that will cover two outputs, basically.
Very handy,
I totally agree. Don't change it yet, because we don't know how good the system's going to be and how good everything is, and it's an added extra change that's not necessarily needed at this stage.
Yeah.
But I would address looking at VAT quarters too. If you are actually MTD IT as well, look at that and line in that now, because I think that will be the biggest benefit rather than year end.
Yeah, fair enough. And just sticking with the quarterly reports for now, and we know obviously these only relate to self-employed income and or rental income. Other things like capital gains, for example, employment income, are excluded. What about where you've got perhaps, say we've got a landlord that's in the UK, but they've also got non-UK property? Obviously, at the moment on the tax return, this is aggregated separately. It's treated as a separate business. Is overseas income included in the quarterly reporting requirements, or is it just UK?
Okay, well, shall I jump in there? The answer is yes. I mean, the delineator here is whether or not you're UK resident.
Right.
It's relatively simple. So if you start with your residency status, if you're UK resident, then it includes all the income that you would report on your tax return as is now, which would include the foreign income. So yes, it does. So if you've got a foreign property, that is part of your MTD reporting if you're a UK resident. Conversely, if you're a non-UK resident, if you've got a client who's non-UK resident but has UK income, So let's say a UK property they let, and might be fairly common situation, then they only have to report obviously the income arising in the UK. Everything outside of the UK is not reportable. So it's fairly straightforward from that point of view.
Okay, well, that's good. That will be a relief.
I think I just want to add something there, which I'm not sure, because before we move on, maybe looking at what is qualifying income and so on and so forth. But a really important point is that quarterly reports are required for each source of income. So if you've got two self-employments and say 4 properties that you're letting, the property business are always aggregated and treated as one business. Yep. So you've got one business there, you've got 4 quarterly reports for that. The 2 self-employed businesses, it's entirely separate, entirely different types of business. They will each have 4 quarterly reporting requirements. So you've got 12 quarterly reporting. Well, it's and at the end of the year, it all gets summed up on the one the one quarterly report, which, as I said earlier, your software, if it's compatible, well, if it's not compatible, you can't use it to file for MTD. If it's compatible, then it will correlate. It will bring all that information in. So it'll be automatically populated onto your year-end report.
Well, that raises an interesting question then, because so if we're saying self-employments, the sole trades are separate for reporting purposes, are they also separate for the purposes of considering the mandation thresholds?
No.
So if I've got two sole trades and they happen to be about turning over 30,000 each, can I say, well, I'm outside MTD because even though I've got total income of 60,
it's divided
separately
between 2. Simple answer to that is no. It's the aggregation of not just all your sole trade income, but your property income. So if you had 40,000 from sole trade and 15,000, bearing in mind we're talking turnover here, and not net income or net profit. So if it was 40,000 from self-employment and 15,000 from rental income turnover, and that was in the year 24-25, then you will be mandated from April 26. So no question about that. And I think at some point you definitely need to talk about what is qualifying income here. So I've mentioned that a couple of times.
Yes, no, I was going to say it might be a good time to bring that up now. So what exactly is in and what's out in terms of?
Well, actually, having made a fuss about it, it's actually relatively simple, but it is important. Essentially, it's all turnover that is from self-employment and all turnover that's from rental income. What you can it's more about what you can exclude, and you can exclude, because we've had this basis period reform. You may have opted for spreading relief, which is where you've taken if you like, the double charge that arose when you moved from when you moved from the basis period was changed, and it's always the tax year. You may have had this excess of taxable income, which you can spread over 5 years. That is excluded. So it's important that is excluded, and in fact it shouldn't really crop up anyway, but just for anyone that's wondering whether or not they should bring in or someone who's within or outside of MTD, that is excluded. The other thing is excluded. I think this is a really practical issue that I was thinking about just this morning. And it's a question I often get asked. If you're it's on a sort of micro scale here, when you're posting, if you've got a client that is recording or charging expenses to their clients, so they issue an invoice, and it's so your client issues an invoice to their customers, their clients, and it says, okay, £1,000 for services plus my travel costs, my other travel accommodation expenses, it's important that you post though that is part of your supply, so that the total value of your supply is the total of the invoice there. So including the travel costs, including the accommodation. What should be excluded, the only time you can exclude expenses is if they are true disbursements. So in other words, if you are incurring an expense on behalf of the client, not so it's very much the same rule as it is for VAT disbursements. So if, for example, you were carrying out a legal search for a client and it's their liability, their bill, but you've actioned it at their request, you can pass on that charge, and it's a disbursement that you can exclude. So if you have if your business involves a lot of disbursements, then it's important that you actually record those expenses separately. So what you might need a separate code when you set up, or if you haven't got one already, to ensure that disbursements are itemized or at least left out, so that you can, if someone is borderline on qualifying income, whether they've reached the limit or not, then you can exclude that. Sorry, I've talked on a little bit there at length, and if anyone's got any questions,
it's important stuff, isn't it?
Yeah.
I'm going to move on because I'm conscious that we're know, time's going through, and I do want to get on to talking about software and things. So Natasha, can I bring you back in for some practicalities? I mean, a big concern that I remember seeing a couple of years back now, and probably still, although maybe to a lesser extent, is whether people are going to have to purchase, software in order to do this kind of stuff. And there's been reassurance throughout that spreadsheets will still be acceptable, because of course for smaller businesses, that they might not want to be spending money each year on software packages, and they may be able to just use Excel. But as I understand it, the spreadsheets are going to have to be able to interact with, something's going to have to be able to pull that information from the spreadsheet. So is it going to have to be in some kind of standard format, and is that available yet, do you know? Or, what can you tell us about that kind of side of things?
It's going to be the same principle as the VAT. So you will have these bridging softwares, which will then set up their own templates, which will then extract the data. The whole point of it is that you're not actually typing any of that data once it's in the spreadsheet. So the bridging softwares are coming out. There's going to be other softwares that will actually pull that information in there that's quite cost effective as well. And those who don't just want spreadsheets, there is software that's going to be coming out that's supposed to be free as well to alleviate that. I know that Sage were a big advocate of this. They wanted to bring out free software that could do these returns and the help the end user to do these. But the Excel is still going to be a fabulous way of getting that information in there. It's always been an old school accounting tool, and it still will be a forefront of our accounting tools, no matter all these fandangled cloud softwares, which we all love, and the AI. Excel will be a big player for those who need it. And bridging software out there is very cost effective as well to get that information. And they have these excellent tools that will extract the right data as long as you've got it in the right format. And they are so helpful getting you to that point where it's just a question of updating your spreadsheet, and then that will link.
It'll do it automated. Can I give you a scenario? Because I don't really do much client work anymore. I occasionally help out some family, but I've got one chap in mind who I know is going to be pulled into this, probably not next year, but possibly the year after. And I know doing it's going to be a nightmare, because he absolutely is a shoebox client. Albeit I usually get quite a guilty sounding phone call around the 25th of January to say that he's got his stuff ready. All he does with me is he sends over an Excel sheet. It's one page, so there's one worksheet, and it's 2 columns, and there'll be, income, and then just a brief description. Presumably that's not going to be enough, regardless of whether it comes over quarterly or not. So if I'm acting on his behalf, say if I were to register as his agent, and I could convince him to send that over to me on a quarterly basis, I'm then going to have to put that into a format that is, that'll work with the API for my software. Is that a satisfactory digital link if he's preparing a spreadsheet and then I'm putting it onto a better spreadsheet, for want of a better word, or am I going to have to get it into his head that he's going to have to use my spreadsheet, which then directly interacts to the quarterly filing software?
I have client at the moment where I use their spreadsheet as the source, but I
Yes,
have links to my spreadsheet that actually gets the information in the right
I see.
format.
Yeah,
So I don't actually touch anything on his spreadsheet. I'm
yeah.
actually pulling the figures off. Obviously, I check it against the facts and figures with
Mhm.
receipts and things like that. To me, that's my interpretation of the MTD rules, is the fact that there's no actual manual changes data. You're actually pulling the
From that
figures from,
first input.
yeah, and then that is then linked directly to an uploading into bridging software.
Yeah,
And there's all traceabilities back there because you can actually see the links where I pulled the data from.
yeah.
There's no actual manual input anywhere. And I think that was
Excellent.
the
Yeah.
key point when we transitioned from VAT, was the fact they wanted no manual input. The Excel format was excellent, was still an acceptable
That's
premise for
that's
using.
handy to know. I think there was a lot of concern about that because you know, and I guess as an extension of that, very small businesses who may not be mandated in the early years, but you know, simple traders, the accounting records may simply be a bank statement, you know, with it, you know, income and
Yeah,
outgoing. So
but
presumably
there
that
but there is amazing software out there that are low cost that will just
mm,
take the bank statement and generate this information from it. And
automatically.
yeah, there is fabulous software out there.
Mm,
I'm thinking of things like auto entries accounts prep. So there you have the facility where you have the bank statement. You also have cash receipts you can put on there, and then
yeah.
that's creates a digital trial balance and digital kind of footprint to MTD. There is softwares out there that are cost effective, but spreadsheets are still acceptable. It's just the
Mm,
manual kind of transmission of that figure to HMRC that
yeah.
you can't actually go into HMRC, type those figures in, or
Yeah.
manipulate the data like that. They need to see the electronic footprint of where it's
Yeah.
come from.
Excellent. Okay, that brings us on quite neatly, I guess, to workflow management, which again is probably you'll be better placed than Tony or I to talk about. And we have actually got a question in the Q&A asking, will agents be charging 4 times the current fee? And I have seen some things in, you know, in discussions in forums with agents saying things like how much extra are you going to be charging for it? Is it really 4 times as much work, or is it merely a kind of a more of a spreading of the workload? So
I've
um,
seen so many different answers to this question, and some are astronomical prices that they're expecting to charge clients.
mm,
My theory is that I've always charged self-assessment clients monthly for
yeah,
providing it, because obviously I'm getting their receipts monthly, I'm processing them, and that's my theory. I believe there probably should be a smaller fee for the quarterly returns, but not to the extent of 4 times the fee. I don't think, personally, ethically, I couldn't do that.
no,
That's just me. It depends on the complexity of the client, the receipts,
mm,
the information. Um, Workflow, if most of my clients now are, regardless of whether they're VAT or ITSA or anything, I do their bookkeeping a minimum of monthly. I think that's the good ethical thing. If you can get into a routine of doing your clients' bookkeeping, that's your source of information. Or if your clients are doing that bookkeeping, that's the source of the information that you're going to be
mm.
doing these returns. So
Yeah, presumably if you're
if you
doing
can
it
get that,
monthly or fortnightly, it's
yeah.
kind of taking care of itself, isn't it? So yeah,
Exactly. And then obviously you will always get, like Tony mentioned earlier, you will always get year-end adjustments because you've got things
mhm,
like pension contributions, you've got
yeah,
employment details, you've got things that you can't do, capital allowances and things like that,
yeah,
things that you
capital
don't normally
losses.
generally do monthly.
Mm,
And the 4 times the fee, I do not think that's fair. That's me personally. I'm going to put my hands
no.
up and be quite political and say, I believe not 4 times. I do believe there should be an increase,
Yeah,
but
I
not
mean,
not 4 times.
potentially there's going to be some additional, you know, I don't know if
Yeah,
insurance things might go up or, you know, I mean, insurance things tend to go up every year anyway, but
yeah.
you know, if clients are, if advisors are having to invest in new software, I suppose it's natural that some of that cost is going to be passed on. That's just kind of the way that business works. But
Yeah, I
I
mean,
think you're
I
right.
did.
I think if I had an accountant and they suddenly told me that they were putting my fee up by 400% for essentially doing the same work, I'd probably be looking for another accountant.
Yeah, I think I saw a really interesting post a few weeks ago, and I think it was somebody who was doing a talk, and they said they're going to do the same kind of principle as VAT returns. So they charge a nominal fee per the income level and the amount of transactions per little return, and still the same fee as they would do their statutory return each year. So it's kind of not 4 times. I think it worked out as something like 1.75% increase or something. So it's kind of minimal, but they said it, they saw, like I keep saying, they saw it as an opportunity to help their client more, potentially help them grow and potentially become bigger in the long run, which gives them the benefit anyway.
Yes, of course. Yeah. Okay. Right. Can I pop back to Tony briefly just to talk about something we pushed on? We are running out of time, but I do want to talk about penalties. And for if you should have been mandated but don't realise perhaps. What's the framework for being charged penalties? Because I believe it's different to the current self-assessment system.
Let's just start from the beginning on that one. It's actually not that complicated. We are moving from the current system to a point system at a time in the future, generally. So I don't think there's a specified date yet for the point system. It was going to start earlier. But as it stands, only the VAT penalty system works on points. However, the system will be applicable to any person that registers for MTD, except if they register voluntarily. So if you're mandated for MTD, the new penalty point system, and I'll get to what points means pounds in a moment, but if you're mandated into the system, you will be on the points system for penalties. If you're voluntary registering, and that includes the current testing program, then there are no penalties for late quarterly returns. There are late payment penalties, but they're separate for the moment, and I'll come back to those if we've got time. So as it stands, if you're mandated, starting for MTD, starting from April next year, you get a point, a penalty point awarded each time you're late with a quarterly return. A quarterly report. You need, when you hit 4 points, there's a penalty, which I think it is. Let me just check my notes. It's either £200 or £300.
200 is the one for VAT, and it does sound like it's.
There's also a regime for the annual return, if you like, which is the final report. That has a different threshold. That has a 2-point threshold, and if you miss one, then the next one will be, you'll be penalised at £200 as well. So there's a two-tier penalty system there, but it's based on points, and it only applies to you if you are mandated for MTD. If you're not mandated, the current system will continue until such time as the government decide, or the revenue decide, that you will be that it's going to apply to everyone. I said, in addition to that, there's a late payment system, and that's quite harsh. So of course there's no change in the due dates for payment under MTD. It's still 31st of January, 31st of July. But under the new system, if you are 15 days late, you will be hit with a 3% penalty, 3% of the tax paid late. And then after 30 days, i.e. another 15 days, there's another 3% charge. and then thereafter, from day 31 onwards, interest or penalty charge continues to accrue at 10% per annum. These are separate from interest charges, but so the penalty itself is, as I said, after 30 days is 10% per annum on the outstanding tax. So it's both fairer in terms of late return. So if you miss the return here and there, you're not going to be penalised. But if you are consistently late, you will be penalised. You'll be penalised quite harshly. There's not really much more to say on that. There are of course finer details, but it'll be interesting to see how that pans out. It should be better, really, for most people.
Yeah. Okay. I've got another couple of questions from the Q&A, and then I think we'll have to wrap things up, if that's okay. This one's, the first one's about property, for landlords. Do property expenses have to be reported on a quarterly basis, or is it just the income? Natasha, can I pop to you with that one?
Expenses have to be done as per category each quarter as well. So that doesn't matter whether it's property, whether it's basically looking at all your businesses. So yes, they do.
Yeah.
And can I just leap in there? There's just one relaxation, isn't there, Natasha, and that relates to jointly owned properties.
That's right, yeah.
Where they've stepped back because they realised the difficult practicalities. So if you own, let's say, a property jointly with your siblings, 3 or 4 siblings or something, and there's one of them in control of the sorting out the accounts and the finances, then all you have to report at it's a relaxation. It's not a set change because the revenue is still struggling in how they're going to finalise the terms for this. But at the moment and for the foreseeable future, you will just need to report your share of the gross income. And then at the end of the year, you can put in the expenses. You don't have to. I mean, if you have all the information, then you report it. But it's only your share, of course, that you'll be reporting. So, but the relaxation is you can just report the income based on your share. I think it's your share. I'd have to check that. It's either your share or the total income. Do you know that, Natasha? I'd have to check that. But I
think it's your share on this case when it's more than one party with the property owners.
Okay.
It's share.
Okay.
Excellent.
Yeah.
So that would make sense because it's going to give you a running estimate of your tax liability, isn't it? Which wouldn't. Just on those, you mentioned categories there. I believe expenses and things have to be reported in fixed headings that are dictated by HMRC. That goes for both self-employed people and landlords, isn't it? So there's a set range of where these expenses will need to be reported or how they're recorded. So repairs will be recorded as repairs. It seems obvious, but isn't there there's a slight relaxation for smaller businesses, isn't there, where they can? Is there something with 3-line reporting where they can report on a simplified basis in some circumstances?
Yes, there is. It's determined about whether it's an adoption from the current self-assessment system, where if your turnover is less than the VAT registration limit, then you can do a 3-line account. I think it would just be 2 lines because the final line is just the difference between the 2 others. But,
of course,
a 3-line account effectively. So yes, that will continue. So you can still do that, and the categories are. The revenue is not quite the same, but and certainly Natasha would know this better. But I think they've largely tried to adopt the same reporting categories as the self-assessment system. So as to exactly how that works out in practice, Natasha would certainly have a better idea than I.
Yeah, and I think a lot of the softwares that are coming out to offer the kind of simplified versions to get that information to have adopted that. They've adopted the process that when you code all the expenses and things like that, they just go into those select few codes rather than having a full chart of accounts. It basically fits that niche a little bit easier for submitting purposes as well.
Got another question here. I think the answer's no, but I'll just check with both of you. The quarterly reports, is that just income and expenditure, or do balance sheet items have to go on there as well?
The answer is no, no
Yeah.
balance sheet items. Simple
I
as
thought
that.
so. Yeah, that's a nice easy one. So, and then the last question that's in the Q&A, and then I will wrap things up. Is there any is there a potential incentive for the term is used is they've used is tricky clients to incorporate I presume to sidestep the mandation. I guess the problem with that is it brings in a whole can of worms about other things and legal framework. But can I get your thoughts on that very quickly? Both of you.
I'll start. I think the answer is you're kicking the can down the road is the first thing to say. And to use another metaphor, you're letting the tail wag the dog. So there's two metaphors for the price of one, but I think they're both relevant here. You have to look at your motivation and then also what the consequences are. Maybe you may end up with more cost and more hassle incorporating. I'm not saying don't. I'm just saying I would not use MTD as an excuse to incorporate.
No. I mean, making tax digital for corporation tax is going to be coming, isn't it, at some point as well? I think that's almost certain. Once we've had a full rollout for it, so I think that'll do there. What I was going to do, Natasha, was turn to you just to ask for 3 top tips for what to do now if you're somebody that's got clients that are going to be affected by this. So, whether you're a bookkeeper, accountant, tax advisor, what should you be doing as opposed to what should the client be doing?
Okay, so I would suggest that the 1st of July is a great starting point to actually start trialing your clients who are going to be affected by this, if you haven't already, in getting them to a routine to get that information to you quicker. Doesn't matter how it gets to you, but that's the imperative. Then you've got them into a kind of a 3/4 process before it comes live. The second top tip is give your clients as much information how it will impact them. So don't scare them, do it in bite-sized ways, but highlight the benefit that it's going to be. Say, like, did you know by doing this we can actually do X, Y, Z, or you can have this kind of information. Don't scare them off with the costs of it as well.
Okay.
Look
Brilliant.
at how much time it's going to take you to do it, how much time is going to impact the client. Remember, some of these clients are, although they are going to be mandated to do it, are kind of small clients. You need to look at the impact of how much this information is and really look at your costs of how much you're going to charge them that. So they're the 3 important things. Get them to a routine, educate them a little better, and look at your costs.
Brilliant. Summed up perfectly succinctly there. Okay, well, that just about wraps up for this session. I hope you found it informative and useful in practical terms. I'd just like to thank Tony and Natasha for joining me today, and hope to see you in 2 months' time when we'll be looking at the changes to the tax system for non-domiciled individuals. Until then, it's bye for now.